I think it's a very good question, Bernie. If you look at the way the market looks, if you take out geopolitics for a minute, then yeah, economically, the world economy looks pretty good. But you cannot ignore the geopolitical environment, whether it be in Europe with Catalonia, whether it be with North Korea, whether it be potentially with Turkey coming up in relation to that little spat with the United States. If you look at the VIX, it's at historic lows since it was listed. CTAs and hedge funds are as short as they can get on the VIX, yet stocks are at record highs. It suggests the market isn't prepared for any major shock, even though we have a lot of geopolitical risk around. They're not really ready for something to happen. So what could happen if, what is going to trigger a potential move and how the market reacts. So I guess if you look at the stock market, it's hard to buy it, but it's also hard to sell it on the way volatility is and the way momentum is.
Yeah, that's the thing, Toby, because this low, this almost zero or low interest rate environment the past several years has been accompanied by a proliferation of new ways for people to invest, right? Low rates mean that people find it harder and harder to, achieve the kind of yields that they need to keep up. So, they're ETFs, smart beta funds, all kinds of things, I mean, we've seen the fund industry, the ETF industry proliferate, and yet the liquidity isn't there. I look at the ETFs that are tracking the S&P 500 here in Hong Kong, and it's trading like 5 lots a day, and I'm going to myself, how in the world could an S&P 500, ETF that, at 10 basis points expense ratio, how can it have 5 lots a day? I don't understand it. Can you shed some light?
Well, I don't know if I can shed some light on the mechanics of it all, but suggest to say that when in a low rate environment, people have been chasing yield, so they move down the risk curve, and they tried looking for smarter ways to chase some return, and so they'll trade in assets that may be less liquid, maybe priced against real assets. But the concern there is that it's a bit like taxis in the rain. When the rain falls, the taxis disappear. They're everywhere up until you start to see that some rain falls. I think a little bit in some of these products and some of these areas where people are taking risk that they may not see as vulnerable, but in fact, in a liquidity event, they're very vulnerable. So I guess that's the area where we're most concerned, is the market just isn't ready for a major shock in terms of illiquid assets.